Good morning and welcome to TOITOI Japan Market Radio. I'm coming to you from Tokyo on Friday, March 20th, 2026. This is your daily briefing on Japanese equities, currency, and rates, designed specifically for global investors tracking Japan exposure. Before we dive in, I should note that Japanese markets were actually closed today for a public holiday, but there's still plenty to unpack for positioning ahead of next week's open.
Thanks for having me. So yes, markets were shuttered today, but the global backdrop has been moving quite actively, particularly around geopolitical themes and energy markets. For Japan watchers, the key overnight developments center on Middle East tensions and their implications for oil prices, which as we know matter a great deal for a country that imports the vast majority of its energy needs. We also saw some notable single stock action in Japan Post Holdings earlier in the session, which I think is worth touching on as a sentiment indicator.
Let's start with the geopolitical side, because this has been dominating headlines globally. We've seen reports suggesting that the United States and Israel are working to dial down concerns over a potential escalation with Iran. Oil prices have actually declined on these signals. Walk us through why this matters specifically for Japan.
Sure. So the context here is that oil prices fell after both the US and Israel indicated they're taking steps to reduce tensions around a possible conflict with Iran. That de-escalation messaging has taken some of the near-term geopolitical risk premium out of energy markets. For Japan, this is significant because Japan is one of the world's largest oil importers with virtually no domestic production. Lower crude prices directly improve Japan's trade balance and reduce input costs across the board, whether that's manufacturers, utilities, or transport companies.
And presumably that has knock-on effects for inflation expectations as well, given where the Bank of Japan is in its policy cycle.
Exactly. Lower energy costs ease deflationary pressures, which is particularly relevant right now because the BOJ is still trying to sustain inflation and support monetary normalization. Geopolitical de-escalation in the Middle East also reduces the risk of supply shocks to Japan's critical energy supply routes, which is a tail risk that markets tend to price in during periods of uncertainty. So from a macro perspective, this is broadly supportive for Japan's economic stability.
How should investors be thinking about the market impact, then, once Japanese equities reopen next week? What are the likely effects on the Nikkei, the yen, and JGBs?
For equities, I'd expect a modest positive bias. Lower oil supports downstream manufacturing competitiveness and improves corporate margins, especially in energy-intensive sectors like chemicals, autos, and transportation. That said, the benefit may be somewhat limited given Japan's already sluggish domestic demand environment. On the yen side, we could see marginal weakness. Lower oil prices tend to reduce inflation expectations globally, and that can narrow the interest rate differential between Japan and the US, which would limit yen strength. And for JGBs, yields are likely to remain stable or drift slightly lower. Lower energy inflation reduces medium-term inflation expectations, which supports demand for JGBs and keeps yields anchored.
Now, it's worth noting that earlier this week, we also saw coverage pointing to the opposite risk, which is the potential economic fallout if tensions with Iran were to escalate rather than ease. Reuters ran a piece asking which economies would hurt most from an Iran conflict, and Japan was flagged as particularly exposed. Can you unpack that for us?
Absolutely. Japan's exposure here is significant, and it's primarily driven by energy dependency. Japan imports roughly 80 to 90% of its oil, and the Middle East accounts for around 40% of those supplies. So any disruption tied to Iran, whether that's direct conflict or instability affecting critical choke points like the Strait of Hormuz, poses a real threat to Japan's energy security. Beyond that, Japanese manufacturers rely heavily on stable energy costs to maintain production competitiveness, and Japan's critical shipping lanes run straight through the Persian Gulf.
So if the situation had gone the other way, we'd be looking at a very different set of market dynamics.
Correct. In a risk on Iran scenario, we'd expect negative pressure on the Nikkei and TOPIX. Oil-intensive sectors like transport, chemicals, and utilities would face margin compression, and you'd likely see broader risk-off sentiment weighing on cyclicals. The yen would probably strengthen in the near term due to safe haven flows, though higher energy import costs would create an offsetting headwind over time. And JGB yields would face downward pressure as investors pile into quality assets. The BOJ would almost certainly maintain its accommodative stance amid that kind of global uncertainty.
Right, so the de-escalation narrative we're seeing now is clearly the more favorable outcome for Japanese risk assets. Shifting gears a bit, let's talk about Japan Post Holdings, because even though markets were closed, we did see some notable price action there. The stock rallied 3.3% intraday and hit a day high. What's the read-through here?
Japan Post Holdings is a major constituent of both the Nikkei 225 and TOPIX, so moves of that magnitude do carry some weight. The company is a significant player in Japan's financial system, spanning postal savings, insurance, and banking services. A 3.3% single-day move suggests there was either meaningful positive news flow or a shift in sentiment around domestic-focused, dividend-yielding blue-chip stocks. Given its substantial market cap and index weighting, intraday strength like this can provide modest positive momentum to the broader indices.
Do we have clarity on what drove the move, or is this more of a technical or sentiment-driven rally?
The reporting didn't provide a lot of detail on the specific catalyst, so without clarity on earnings, corporate actions, or sector news, this appears to be more of a tactical move rather than a structural shift. That said, strength in a name like Japan Post can signal investor appetite for defensives or domestically oriented services, particularly if there's a view that domestic consumption narratives are improving. From an FX and yields perspective, a single stock move doesn't have much direct impact, but sustained strength in Japanese equities could gradually support the yen if it signals improving domestic growth sentiment.
So worth monitoring, but not necessarily a game changer on its own.
Exactly. I'd keep an eye out for follow-up reporting or any sector-wide trends that might clarify whether this reflects broader conviction or just a one-off position adjustment.
Let's bring this together for our audience. We've got a holiday-shortened week, but the macro backdrop is still very much in motion. What are the key themes global investors should be carrying into next week's open?
I think the main theme is that the geopolitical backdrop around energy remains a critical variable for Japan. The de-escalation signals we've seen are constructive for Japanese equities and supportive for margins in energy-intensive sectors, but investors need to stay alert to any renewed flare-ups in the Middle East. Energy security is existential for Japan, so even modest shifts in oil prices or supply risk can have outsized effects on sentiment and positioning. On the monetary side, the lower inflation impulse from declining energy costs gives the BOJ more room to maintain its gradual normalization path without rushing into aggressive tightening.
And for those tracking the yen?
The yen is likely to remain range-bound in the near term, with competing forces at play. Safe haven flows could support it if global risk sentiment deteriorates, but lower inflation differentials and stable oil prices may limit sustained strength. I'd be watching U.S. economic data closely, as that's likely to drive the dollar side of the equation more than anything happening domestically in Japan.
Great context. Before we wrap, just a quick reminder that if you're a global investor following Japan's markets, we release these briefings daily. Consider subscribing so you don't miss key developments in Japanese equities, FX, and rates. Thanks for joining us today.
Thanks for having me.
That's it for today's TOITOI Japan Market Radio. We'll be back next week with more coverage from Tokyo. Stay informed, stay positioned, and we'll see you next time.